In this video, we're going to talk about the 2023 housing market and how we are not going to have a housing market crash. The Debbie Downers say, hey, we're in a housing bubble. The 2023, we're going to have a housing market crash. Home prices drop by 50%. It will be worse than the 2008 market crash. Disaster coming. Buckle up. Blah, 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 blah. So much negative talk, but I do get it. The housing market accounts for up to 17% of the US GDP, so it gets featured daily in your local and national news, and it impacts many of us, so they like to report the negative side. So they report things like home prices dropping by 20% or more, interest rates rise again, home sales drop, new builders are having problems selling their homes, foreclosures are up. Then, of course, they feature a family getting kicked out of the home. But stop. We are not going to have a housing market crash coming in 2023. I'm not saying that the market is turning around, though I am seeing an increase in showing activity here in California. But we're not going to have a crash. As a matter of fact, Lawrence Yun, the chief economist of the National Association of Realtors, agrees with me. He predicts that the housing prices won't see a significant decline, especially if the interest rate remain at around 7%, and a possibility of a slight increase. So if prices do drop, it won't be much. Is there anything supporting my and Lawrence's claim? So today, we'll look at the hard numbers and the trends of the market, and also compare what happened to the crash in 2028 to what's happening now. Then let us know what you think in the comments below. I'd love to hear what you have to say about this subject. Let's get started. What is that saying? If you don't learn from history, you're doomed to repeat it. Well, how many of you remember the 2008 market crash? What comes to mind when I say Washington Mutual or Countrywide? By the way, that's an inside joke if you've been in the business for a while. But anyhow, home prices dropped by 30% during that time. Foreclosures were up a record 81% in 2008. What was scary was that there's no light at the end of the tunnel. There's no relief in sight for the following year. You turn on the news and they report Lehman Brothers were closing their doors. Merrill Lynch, remember them, was bailed out when Bank of America bought them out. AIG, another large financial institution, was downgraded. The stock market was tanking. Foreclosures were up 225% compared to 2006, which was when foreclosures started happening more often. I'll have more on this in a few minutes. Let's compare what happened then to what's happening now. Let's start by quickly going over what caused the 2008 market crash. Most loans are backed by the big three: Freddie Mac, Fannie Mae, and Ginnie Mae. They are government-sponsored private mortgage companies. They back loans and set regulations and guidelines. When you get a loan from your lender, those lenders typically follow a qualifying guideline or criteria from one of these three investors. One of these three, depending on what type of loan you get, will end up getting your loan as long as your loan meets their guidelines and criteria. Their guidelines and criteria are what they feel your loan has to meet in order for them to feel safe buying your loan package from your lender and then selling it in the secondary market. To help buyers with less than perfect credit, Freddie Mac and Fannie Mae did come out with what's called a subprime loan, meaning these borrowers were not prime borrowers. They were subprime borrowers, meaning these are people with less than perfect credit and other qualifying credentials. Then came the private label securities market, or PLS. They are similar to the big three, but not backed by the government and not regulated. So these companies came out with their own set of guidelines and criteria, which were very, 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 very loose. Did I say very loose? Towards the mid-2000s, these types of companies expanded, taking more and more business away from the big three. So more and more mortgages were under these PLS companies because, again, their guidelines and criteria were very loose. If you breathe, you got a loan. They found a way to get you approved for a loan. These loans were ARM loans, or adjustable rate mortgage loans. They were hybrid ARM loans with very low teaser rates. Your initial interest rate was very, very low, so you could afford to buy more or a bigger house. Most of these types of loans were interest-only loans, which meant your monthly payments were only towards your interest, or they were called payment option ARM loan. But these initial teaser rates would then reset and your mortgage payment would then double or triple. These were very risky loan packages. These PLS companies would then package your loan along with other similar loans and sell them in the secondary market, and resold over and over, spreading the risk. One thing to keep in mind was during this time, consumer debt was increasing, adding to the strain on these new homeowners. There were many signs that we were in a housing bubble. In 2005, more and more of these loans adjusted, and people started to get overwhelmed with their monthly payments. And foreclosures started to happen. In 2006, there were more and more foreclosures happening. Then, in 2008, that is when the wheels came off. As I mentioned above, home prices dropped by 30% and bottomed out around the end of 2011 to early 2012. So what happened next? What did the government and the mortgage industry learn? What did they do to make sure this didn't happen again? So here's what happened. The first step was for the Federal Reserve to lower the Fed funds rate down from 5.25% down to 0 or around 0.25%. This helped make things cheaper and helped stimulate the economy. They also made it easier to get credit. And to stimulate the economy even further, the Fed started buying mortgage-backed securities to add more money in the circulation. The government came out with many legislative measures to protect you, the consumer, from predatory lending. And on the mortgage side, many homeowners receive housing credit to help them avoid foreclosure. And many homeowners were allowed to refinance even though they were underwater, meaning their home was worth a lot less than how much they owed. Qualifying guidelines were tightened for new borrowers, meaning no more loose guidelines. So if you qualified for a loan, it meant you really did have the financial ability to make your payments, and you can afford the payments with some extra savings to cushion any potential hardship. This meant the debt-to-income ratio was also lower, so the percentage of your mortgage payments is well below what they were leading up to the crash. One of the reasons loans were approved during the lead up to the 2008 crisis was that the homes appraised for much higher than they really were. The reason this happened was the lender was able to work and contact the appraisers directly. Many lenders had their pick of appraisers who they wanted to work with. Now, they no longer have the ability to pick their own appraiser. They have to order the appraisal through a company who will then assign a random appraiser to appraise the property. To show no more favoritism, more eyes were looking at the valuation of each property. This is the short version of what happened. If we go deeper into the subject, this would be an hour-long documentary. So comparing what is happening now, number one, loan guidelines are tighter. Those who are approved for a loan really do have the financial ability to afford the home that they are buying. And they would buy the home at the right valuation because of the change in the appraisal process. Appraisers are no longer connected to the lenders. Better guidelines, stronger collateral assessment, meaning all your overall loan package is taken into more consideration. Better overall underwriting process, and all of this resulting in a stronger and better quality loan. Number two, if you recall, I mentioned earlier that foreclosures were up 81% in 2008, which was 225% higher than what happened in 2026. Take a look at this graph, and I don't think I really need to say too much more on this because the number of foreclosures does not even compare. Here's the graph. Enough said. Number three, another reason why foreclosures are unlikely to increase much is because many homes right now have a lot of equity. So if they can no longer afford to pay the mortgage payment on the home, they can just sell the home. And even if they sell it at a lower price, they will still walk away with money. Number four, the number of months of inventory is still historically low, and many sellers are starting to pull their homes off of the market. And there are not a lot of new homes coming on the market because these sellers have a lower rate on their current home. So when they buy a new home, that new home will have a higher rate of interest on their mortgage. Just take a look at these two charts. You can see the current months of inventory, and then you compare that to what is considered a normal market, which is between 4 to 6 months worth of housing inventory. Housing inventory of 6 months or more is what is considered a buyer's market. Number five, inflation has been declining since June 2022. and mortgage rates typically follow inflation. The lower rates have given more home builders some confidence, which has resulted in increased housing starts. The lower mortgage rates also have given confidence to home buyers, which shows in the increase in mortgage applications. More buyers applying for loans means more buyers will be coming into the market soon. So if you're looking to buy and are sitting on the sidelines, you're going to have more competition coming soon. More competition may mean a higher price for the home you're purchasing. Number 6. Many people aren't looking at this, but housing formations are having a surge, which means more people are starting to move out and buying a home of their own. Number 7, the median home prices have increased year over year. And it's not me saying this. Take a look at this info from Realtor.com where they track this weekly. And ask yourself, if we're going to have a crash, why are median home prices increasing? Again, I'm not saying that the market is turning around and for you to buy, even though if you are able to buy or want to buy now, there are opportunities. In my other video, I showed a clip of Dave Ramsey where he said, now is the best time to buy a home in the next 5 years. And I'll put a link to that video in the description below. Now, there are areas where they saw a significant drop in home prices, but those were also the areas where they saw a significant increase when the market was hot. Overall, studying these numbers, I think it's pretty clear that we're not going to have a crash in the 2023 housing market. There's just not enough figures to support it. The labor market is still hot and the stock market is having a little bit of a rally. So please don't forget to comment below. I would love to hear what you have to say about this video. And thank you for watching. With that said, thank you again, and we'll see you around town. Watch these videos next.